Hello, hello, hello. My name is Gavin Panu. Welcome to M Trading's webinar. Uh, we will be covering today specifically, we will talk about oil market. Yep, so we'll be covering Brent and WTI oil. So yes, we're going to look at how to trade the oil markets. We're going to look at the differences between the crude and the Brent oil. We're going to understand, first of all, macro data. Then we're going to go into the fundamentals and learn more about technicals. Yep. So it is a full encompassing topic based on just oil. And the key point I would say is remember that oil is a commodity. So it is a resource that is required. So it is an important resource. It comes under the commodity sector, and we will touch on the business cycle. Okay, so let's begin. So the first thing to start off this conversation with is what is Brent oil and what is crude oil, WTI. Yep. So WTI, which is also known as West Texas Intermediate. So this is all the oil that is sourced from the US. Yep. So this is all oil sourced from the US. There is a town called Cushing in Oklahoma where most of this resource comes from. Yep, and naturally, as you can hear, as you know from the name itself, West Texas Intermediates. So also that is based in Texas. Okay, so a lot of the WTI crude oil is heavily weighted from the US. So a lot of the US traders will trade WTI. And then on the flip side, we have another type of oil, which is known as Brent oil. Okay, so Brent oil applies, it is more global. It encompasses Saudi oil, UK oil, Russia, some other parts of Northern Europe, Northern European countries, which also come within Brent oil. Yep. So I would say since 2013, Brent oil has actually overtaken the West Texas Intermediate. So the Brent oil is the one to follow and is the main one to trade. Out of preference, you may decide, okay, I will trade WTI because that is what I've been trading. And in my case, I trade WTI purely because it is an asset that I've traded for many years and I am used to the WTI market. Yep. So overall, I would say Brent oil, if you're looking to trade the oil market, look at the Brent oil as your main leading market to understand the oil markets, and the WTI is seen as your secondary. Okay, so we know we've established the regions oil comes from when it's called Brent and when it's called WTI, but the key one I would say is they are both heavily correlated. So usually you'll see both assets moving in the same direction, but there will be a slight difference on the actual price itself. That is the only difference. Overall, it is 99% correlated on the longer term. Shorter term, there may be less correlation. Yep. So be aware of that. Both these markets are accessible to you guys through your M Trading platform, but be specific. There is no point trading Brent oil and WTI. Taking a percent risk on both, you are over risked. So therefore, if a news comes against you, you're not going to be stopped out in one, you're going to be stopped out in both. So ideally, choose one of those assets and learn to you want to master that particular asset itself. Yep. So look into Brent oil and WTI further for more in-depth information. But the major global outlook is viewed with the Brent oil. Okay, so that covers Brent oil and WTI. What is the difference? Now let's go a bit more into sort of the macro data. Okay, so there are some key macro data you need to be aware of. There are three specific points that I'm going to mention. The first is the direct impact it has on the actual Brent oil or the WTI asset itself. So what has a direct impact is weekly estimates. So be aware of weekly estimates. These are so this evening we will have in a few hours time, I think it's in about 3 hours time, have a look at your economic calendars. You will have API numbers for crude oil. In addition to that, Wednesday is the big number. It's the big number estimate. UK time, it's at 3:30. That is crude oil inventories, and that will give us our overall view of how much is in store. So how much have they stocked up? So we're looking at the difference between the change in that number of barrels of crude which is held in inventory by these commercial firms in the prior week. So it's only 1 week's worth of data, and this is released on a week-to-week basis. Yep. The consistent effect is usually inflationary and growth implications. But let me just bring up the chart. So let me just go into a bit more. So I've brought it up over here. Okay, so I'm on Forex Factory, which is I'm using the economic calendar. We've got a little bit more information over here. Okay, so this is crude oil inventories, which is going to be released tomorrow, so Wednesday at 3:30 p.m. UK time. It is mostly concerning the US dollar, and it is a high impact data. Yeah. So the previous was 2.2 million barrels. The forecast is a draw, so a negative of 2.3 million barrels. And as you can see, if you just click on the link, it gives you a bit more information. So you can have the link from where it's sourced. So have a look at Energy Information Administration. Go into that website for more of an update release. Also what it measures, so we do know what it measures, the change in the number of barrels of crude oil held in inventory by these large commercial firms during the past week. Implications, it depends. It all depends on supply and demand, guys. Remember, this is a commodity, and therefore supply and demand measures and implications have a significant impact. Yep. So another key point to mention, which is also a note on this on this website, which is, okay, we do know US are the largest producers. Yep, so WTI is produced in the US, but the key point is Canada has a sizable energy sector. So most of their economy is based on energy. Yep, so they're the biggest exporters of oil. So a lot of impact will also have not only on the US dollar, but it will also have an impact on Canadian dollar. I'll come back to that a little bit later. Okay, so the key point I want to mention is also have a look at the graph over here. So this would give us a longer term perspective. So far, this is the amount of data that we're viewing here. So we can see on the longer term in the last few years what the crude oil inventories on a week-to-week basis has had, how much of an impact it has. 0 being neutral, anything above is seen as positive, below is a draw. So we can see most recently there has been a significant draw. Yep, so hence why we're now seeing that the value, the price of a barrel of oil has been increasing because there has been a less and a less and a less of a production. Yep, so that is a key point there. So directly you need to view weekly estimates. So you have Tuesday evening numbers, the API numbers, which is a prelim of Wednesday's afternoon number, which will give you a better indication of what is the weekly crude oil inventories. Okay, so that covers the direct impact. Now we're going to look at the indirect impact, which is GDP. The GDP, which stands for Gross Domestic Product. If I just go into this over here. Now, you're probably asking me, okay, how does this have an impact on oil? It doesn't have a direct impact. So the numbers will not have an impact straight away in this particular asset. This is more of a longer term projection. So the view is, if there is naturally more growth, if there's more growth in a particular economy, they are likely to be using a larger amount of commodities such as oil, and therefore there will be required more of a supply and demand. Yeah. So more demand, therefore you'd have to produce more to supply that particular economy. So therefore this is likely to be good for oil. That is the key view there. So a growing market, growth in a particular economy, whatever the country is, will have a significant impact on the price of oil. Now, I can give you a perfect example. A perfect example of this is, so it was beginning of 2016. So beginning of 2016, what happened in China's market? A significant drop. So early, as soon as the Christmas period, so the winter period and New Year's, straight after New Year's, what we started to see on a day-to-day basis that the Chinese market was significantly declining. It declined so much in a day that they stopped trading at a certain point because it hit a threshold of 10%. If a market declines nowadays more more than 10% or hits that 10% level, the market will close at that point there to stop from a significant drop taking place in one single day. Yep, so it's to counter flash crashes and so on. And that is something that they did on a daily basis, and the market carried on going down purely because their original estimate of growth was in 9 to 11% range. And the truth came out where the actual growth has been only between 5 to 6%, and that will cause a significant shock in the market. And that had an indirect correlation to commodities and oil. So be aware of GDP numbers. GDP numbers can have a significant impact on a very short-term basis, but generally it is over a long-term basis. So that is the indirect impact of GDP. And my third point is correlation. So we touched on this in the weekly estimates. So correlation plays an important impact into which assets to trade and how are they all related. We already know that certain assets are related to other assets. Remember, we are in a business cycle. Yep. So the business cycle, markets move in a certain ways over the longer term. I'll show you a business cycle, an example of a business cycle in a little while. But the key point to mention is Canada. So Canada, and to a lesser degree Australia, are significant producers. So there are significant producers of oil, but their significant income from for economic growth comes from the commodities. So they need to sell a significant amount of commodities for their economy to do well. So therefore, that has a significant correlation on their economy. So if their economy is growing and it's doing really well, they are likely to also produce a lot more oil and sell that to other countries. So a drop in oil prices or something significant takes place, that can have a direct impact to the Canadian dollar and the Aussie dollar. Yep. In addition to, it could also have an impact to its indices. Yep. So be aware of that also. In addition to that, China and Japan. China and Japan are the biggest importers of oil. So they're the biggest importers of oil. Therefore, if they reduce, or their economic growth reduces, that would have a direct impact on their currency, which will also have an impact on the commodity itself. Yep. So be aware of the yen, the Chinese yuan, as they are the largest importers, and exporters wise, Canadian dollar, and to a lesser degree, Aussie dollar. Whereas US dollar, yes, the data that we've been speaking about, such as crude oil inventories, this has a direct impact on US dollar. But the US have a significantly strong tech sector, healthcare sector, and so on. Yep, so they have other industries that are more prominent than the commodity sector itself. Yep. So watch out for correlations. Those correlations are not only between the currencies, but it's between the currencies, the indices, which are the economic, which shows economic growth or not, so the economy itself, along with the commodity itself. Yeah. Okay, so that covers the 3 points in macro data, which is direct correlation, which is your weekly estimates, indirect correlation, which is the longer term view of the GDP, and in addition to that, you need to be aware of correlations between currencies, indices, and oil or if you want to put it into commodities. Yep. Okay. So let's go on to fundamentals. So more about fundamentals, which is you need to know two specifics. Yep. Two specifics are you need to know about OPEC members and non-OPEC members. So OPEC stands for Organization of the Petroleum Exporting Countries. Yep. So these OPEC members is a sort of intergovernmental organization, and up till most recent data, it includes 14 countries. So it includes 14 countries. But out of those 14 countries, there are five main members, which are Iran, Iraq, Kuwait, Saudi Arabia, and Venezuela. Yep. And that headquarters, are OPEC headquarters, are based in Vienna. So a lot of their OPEC meetings takes place in Vienna. Yep. And the view is these 14 countries, the amount of oil they produce, it is estimated to be 44% of global oil production. Yep, so 44% of global oil production. But still remember, Brent oil is the leader. Yep. And then non-OPEC members is who you would call Russia, the US, UK, and so on. So they have control over their own oil, and they set their limitations and so on, whereas the OPEC members have to have a regular meeting. So as we can see, it is twice per year. So they have 2 meetings a year to discuss their price levels and so on. Yep. They also discuss the most recent topic has been extremely key to what we've seen in oil, which is a significant uptrend. So we've seen a very strong uptrend taking place in oil from its lows, and that is due to a freeze in production. So they have limited their production, or have put a certain cap to their production, and they've kept that frozen for a certain period now, and that there may be an extension of a further 9 months come 29th of November. So be aware of OPEC members and non-OPEC members. In certain cases, you will have non-OPEC members also agreeing to the freeze of production. So for example, Russia has also been included in the freezing of production, the freezing of their output production. So therefore, that also had a significant impact overall in the oil market. So be aware of both OPEC and non-OPEC members. In addition to these members, and you should follow them on Twitter, guys. You can follow them on Twitter through their website and so on. Yep. In addition to this, you have to be aware of government policies. Government policies and legislators, when they define their statutes and their law, that also has a direct impact on oil. Yep, so the production of oil is also correlated to government policies. And another point to mention is the most recent significant impact that's taken place on oil itself, and which could also be why we've seen oil drop significantly, or why it's dropped to such a low level last year. It could also be linked to solar power. So solar power, so the rise of solar power, in addition to electric energy, so electric cars being built. And for example, in the UK, there's been a law set that by there will be an increase in emissions charges, and they want more people to buy more electric vehicles. Yep. So they are looking to reduce petrol and diesel vehicles, and they want people to start buying electric vehicles. This could have a significant impact in the oil markets, but that is a very long-term view. It is a very long-term view. That's the first point. Yeah. Don't forget, there are many other sectors that require oil on a day-to-day basis. Many other sectors. It's not just vehicles. So that's the first key point. Yeah. So that is a very long-term view. In addition to that, Another key point to mention is the business cycle. So the business cycle is extremely imperative to understanding the commodity world. Yeah. So I've just got an example over here. So this is an example of how this works. Yeah. So the red is your commodities. This is our commodity sector, and what we're seeing is there are stages in the business cycle where the market doesn't go in a straight line up. What it tends to do, it goes into booms and busts. So the bottom over here is seen as your bust area. The top over here is seen as your boom area. You have a series of a downtrend and a series of an uptrend, and this is an extremely longer term view. And what you'll generally see is that bonds are the leaders. The bonds are leading the market. So the bonds are the first one to turn positive and start an uptrend, but also they're the first ones to fail when the market reaches a recession or recession begins. Yeah. In addition to that, then you have your stocks that follow. Yep. Stocks, equities, so individual companies, for example, General Electric, you may have heard in the news, it's taken a significant drop of, let's not go into that though. In addition to that, you have Apple, so you can mention many stocks. But the last one, which is commodities, it is lagging and it's more recession-proof. So it's more recession-proof than stocks are. Yep. So they, in a decline, are the last ones to turn around. So in a decline, they're the last ones to start to show positivity. But when the market starts to turn in a negative direction, they continue to be bullish. Yep. Remember, commodities are a natural resource that is required. Yep. So that's the important part to this. Okay, so be aware of the business cycle. This business cycle is extremely imperative to understanding that the market does move in cycles, and where is bonds, stocks, and commodities overall. Okay, so moving on from there, the final part. So in addition, so we've covered fundamentals, guys. We've cleared up fundamentals there. So we talked about macro data. We've gone into fundamentals. Again, you need to do further research. I can only cover so much in a short period of time. So going on to the chart itself, so technicals. So what I would mention is most technicals work. Yep. So most technical indicators you can use with the commodity sector, especially oil and WTI. So you can use moving averages, you can use the RSI indicator, MACD, stochastics, Bollinger Band, and so on. So that all works really well. But in addition to that, one thing I would add to this is the CCI. Yep. So the CCI, which is an extremely good indicator purely from its timing. Yep. So it analyzes market cycles. Yep. So it is known as the Commodity Channel Index. Yep. So it is an oscillator, so you can see below here, so it's also known as CCI or Commodity Channel Index. It's an oscillator. You have overbought, oversold. You have a region where 0 level, plus 100, and minus 100. It's boundless in the way that it doesn't have a significantly overbought level or oversold level. Overbought is when it reaches above 100, and oversold is when it reaches below minus 100. Yep. The key point to this is that this asset has been used to analyze commodities. So do a bit more research into this. It is an extremely good indicator that gives not only the overbought and oversold signals, it analyzes momentum. So analyze momentum and includes cycles in the market. Yep, so includes cycles in the market by, so when the CCI oscillates above and below the 0 line, that is seen as the more of a momentum indicator because there is no upward or downward limit on its value. Yep, so there's no limitation. So generally you're looking for a buy signal when it's above the 100, or you're looking for a sell signal when it's below minus 100. So there are no boundaries there. You can see that I have adjusted my CCI to 150 periods. So as we include cycles. So what I do with cycles is look at significant lows. So I'm always looking at the troughs, which is the bottoms, yeah, and then I work out what is a significant bottom from this bottom to that bottom to this bottom to that bottom, and I take in the period. So from that to that low, it's about 267. And then we look at the next movement from this low up to that low. That gives us 367 periods. I then take half of that and put that into my CCI, which is why I'm including half the amount of data. So it takes it from this point to this point, from there to there, to give me my range, give me my my momentum indication. And as you can see, there's divergence. So this significant sell-off that's taken place, getting to these lows of almost 26 levels, so almost 26 levels, 2681 there. That the low was reached previous to this. So the low was reached previous to this. We started seeing divergence taking place between these two lows. So if I just highlight that, so from this low to this low, we're actually seeing a higher low taking place here, so a higher low taking place, which led to the next bullish move. The bullish move, our first bullish signal was in this area here. So when we broke through the 100 level, which would have been above this level here. Yep. So this would have been our range of looking to buy with a stop loss for the longer term below this low. Yeah, you could take a another stop loss if you're looking at shorter term, but we are looking at the daily time frame. Small retracement, continue to move bullish since then. We're reaching a high, and this is a year-to-date high, guys. So this is a year-to-date high, and it's a high from we're looking at early 2016, guys, on early 2016 highs. Yep, recently. Yep. So use the CCI indicator to give you better understanding of how the commodity sector is doing, and in particular how the oil market is working within cycles. Yep. And it is a momentum indicator, so it does give you buy and sell signals. I can go through the CCI indicator on a separate webinar with which will go into further detail. But for now, it's just more of an introduction and an overview on how to go about trading the oil markets. So yes, as a recap, we covered what is Brent and WTI, so we looked at the differences between the two. We also looked at macro data, which macro data to be significant, which will have a direct impact, indirect, and looked at correlations. Then we looked at fundamentals, so what do we need to be aware of? We need to be aware of OPEC members and non-OPEC members, government policies, also the rise of solar power and electric energy, and then you need to be still the overview of how the business cycle has an impact in a commodity sector. And this falls into commodities. Yep. Okay, and then we looked into technicals. So yes, you can use all the technicals you usually use. So you can look at price action, support, resistance, trend lines, moving averages, RSI, and so and so. But in addition to that, there are specific indicators that you can use, which in one named commodity channel index, which is designed for the commodity sector itself, because the commodity sector has more reliance on cyclical movement. So therefore, you look to use the CCI indicator in addition to your other indicators. Okay, thank you for listening, guys. I hope you enjoyed the webinar. We will be back next week. Take care. Bye-bye.